Imagine waking up as a bank treasurer and realising that overnight, a single move in interest rates has effectively wiped out 15% of your bank's capital, even though not a single customer has missed a loan payment. Now that might sound exaggerated, but it's exactly the kind of risk that comes under the heading of interest rate risk in the banking book, or IRRBB for short. In this video, I'm going to walk you through what IRRBB actually is, why it matters so much in banking, the different types of risk it covers, how regulators in the UK and EU expect banks to measure and manage it, and the practical techniques banks use day to day to keep it under control. By the end, you should have a clear understanding not just of the technical definitions, but also how this risk really plays out in practice across the balance sheet. So let's start with what IRRBB actually is and why it matters. At its core, IRRBB is about the sensitivity of a bank's earnings and its economic value to changes in interest rates. Now let's break that down. A bank's business model is fairly simple in theory. It takes deposits, often short-term, and then lends or invests in assets, often longer-term. Now, the difference between the interest it earns on assets and the interest it pays on liabilities is its net interest margin, which is the lifeblood of banking profitability. But here's the catch. Because assets and liabilities have different maturities and different repricing characteristics, interest rate changes don't impact them evenly. And that mismatch is the heart of IRRBB. Now, if interest rates rise quickly, a bank might find itself having to pay depositors more almost immediately, while the returns on existing loans are locked in at lower fixed rates. Margins get squeezed. Now, on the flip side, if rates fall, borrowers may prepay fixed rate loans and refinance at lower rates, cutting off a bank's expected income stream. And it's not only about earnings. Interest rate changes also impact the economic value of the bank's balance sheet. For example, a 10-year fixed-rate bond worth £100 today may fall in value if interest rates rise sharply, because new bonds in the market pay a higher coupon. Now that loss shows up as a reduction in the bank's capital position if the bond is marked to market. Now this is exactly what happened in 2023, when sharp interest rate increases left some banks holding large portfolios of government bonds at huge unrealised losses. In a few cases, this was enough to undermine confidence and trigger liquidity runs that brought banks down. Think Silicon Valley Bank. Now that's why IRRBB matters. It's not a theoretical exercise. It's a risk that can seriously erode a bank's profitability and even its solvency. Now let's look at the different types of interest rate risk that make up IRRBB. It's important to understand that IRRBB isn't a single risk, it's a collection of related risks. Now the first is gap risk, sometimes called repricing risk. This is the classic form of IRRBB, and it arises when the timing of when assets and liabilities reprice doesn't match. For example, if a bank funds a 10-year fixed-rate mortgage portfolio with short-term deposits that reprice every 3 months, then when deposit rates rise, funding costs increase immediately while the mortgage income doesn't. Now the mismatch squeezes earnings. The second is basis risk, which arises when the bank's assets and liabilities are linked to different reference rates. So imagine loans priced off SONIA, but deposits priced off Treasury bills. Both are interest rates, but they don't always move in lockstep. If one goes up faster than the other, the bank's margins change even if the repricing timelines match. The third is option risk. Now many banking products contain options, either explicit or embedded. Mortgages can usually be prepaid. Deposits can often be withdrawn early. Some loans have caps and floors. Now customers will exercise these options in ways that usually disadvantage the bank. For instance, repaying a mortgage when rates fall so they can refinance at a lower rate. That makes the cash flows uncertain. And finally, there is credit spread risk in the banking book, or CSRBB for short. Now, regulators in Europe now explicitly expect banks to monitor this. Even if rates don't move, the market may demand higher spreads for holding certain credit instruments. Now that means the market value of a corporate bond, for example, can fall even without a default. It's not strictly interest rate risk, but it has similar impact on the bank's economic value. So IRRBB isn't just one thing. It's about timing mismatches, different benchmarks, customer behaviour, and market valuation changes all interacting together. Now let's turn to how regulators view IRRBB. Globally, regulators recognise that IRRBB is one of the most significant risks for banks. But unlike credit risk or trading book market risk, IRRBB doesn't have a fixed Pillar 1 capital charge under Basel. Instead, it falls under Pillar 2, which means regulators expect banks to measure, manage, and hold capital against it based on their own balance sheet characteristics, subject to supervisory review. Now, the Basel Committee updated its standards in 2016 and required banks to run a set of prescribed interest rate shock scenarios. Now, these scenarios include a parallel upshift in the yield curve, a parallel downshift, a steepener where long rates go up while short rates go down, a flattener where long rates fall and short rates rise, a short-term upshock, and a short-term downshock. Now, banks have to report the impact of these shocks on both earnings and economic value. Most importantly, Basel introduced the supervisory outlier test. If the economic value of equity falls by more than 15% of Tier 1 capital in one of those shocks, the bank is flagged as an outlier and supervisors will take action. Now in Europe, the EBA guidelines are particularly detailed. Since 2018 and updated in 2022, the EBA requires banks to measure IRRBB under both NII and EVE perspectives, to apply constraints to assumptions such as the 5-year cap on non-maturity deposits, to run standardised outlier tests for both EVE and NII, and to treat CSRBB explicitly alongside IRRBB. Now in the UK, the PRA follows a very similar approach. Through the ICAP process, banks have to show how much capital they need for IRRBB, and supervisors can impose Pillar 2 add-ons if exposures are too high or models aren't robust. In short, the regulatory message is clear. Banks must measure IRRBB comprehensively, set limits, and prove that their governance and controls are strong. So how do banks actually measure IRRBB? Well, there are two core lenses. The first is the earnings perspective, which looks at changes in net interest income over the next 1 to 2 years under different rate scenarios. This is sometimes called earnings at risk. Now, the second is the economic value perspective, which revalues all expected cash flows under rate shocks and calculates the change in the bank's long-term net worth, or EVE. Now, these two perspectives complement each other. Earnings shows the short-term P&L sensitivity, while EVE shows the long-term value risk. Now, regulators and boards want to see both. On top of that, banks use tools like repricing gap analysis, duration gaps, PV01 sensitivities, and full scenario and stress testing. But here's the crucial point. The accuracy of those measurements depends heavily on behavioural assumptions. Non-maturity deposits like current accounts don't have fixed maturities, but are usually quite stable. Banks have to model how sticky they are and how much of a rate increase gets passed through to depositors, known as the deposit beta. Now, if those assumptions are wrong, IRRBB numbers can be misleading, and the same goes for loan prepayments. If more customers refinance when rates fall than the bank assumed, then income disappears faster than expected. That's why supervisors pay so much attention to model validation, backtesting, and conservative caps on assumptions. Now, once measurement is in place, governance and oversight ensure that risk is managed properly. Numbers alone don't manage risk, governance does. Now, most banks have an asset liability committee known as ALCO that meets monthly to review interest rate risk alongside liquidity and capital. ALCO checks exposures against the bank's risk appetite, decides on hedging strategies, and challenges assumptions. Now, it's the board that sets the appetite. For example, it might state, under a 200 basis point rate shock, NII should not fall by more than 10% and EVE should not fall by more than 15% of capital. Now, it's the first line, which is Treasury, which manages the positions. And it's the second line, which is risk management, who measures, monitors, and challenges. Now the third line, internal audit, ensures the framework is sound. And that 3 lines of defence structure is critical, and regulators in the UK and EU explicitly expect it. Let's now talk about how banks actually mitigate IRRBB and the hedging strategies they use. Now, banks reduce IRRBB exposures in several ways. They use natural balance sheet hedging, for example, by funding a portfolio of 5-year fixed-rate mortgages with 5-year fixed-rate deposits or bonds. They use derivatives, with interest rate swaps being the workhorse, while options like caps, floors and swaptions can also hedge option risk. They rebalance the balance sheet by adjusting the investment portfolio or product mix to reduce mismatches. They use pricing strategy, steering customers into products that align with the bank's desired risk profile, and they employ funds transfer pricing, so charging business units internally for the IRRBB they generate so Treasury can centralise the risk management. Now, all of these involve trade-offs. Now, hedging usually comes at a cost, and sometimes banks choose to leave some exposure open to benefit from a particular rate view. But that decision has to sit within the agreed appetite and limits. So why does IRRBB matter so much right now? Well, for years, when rates were stuck near zero, IRRBB seemed like a manageable risk. Many banks and supervisors got a little complacent, but with the sharp and volatile rate moves we've seen since 2022, it's back at the top of the agenda. Banks that had robust IRRBB frameworks, strong governance, and sensible hedging strategies have managed the volatility well. Banks that didn't and relied on optimistic assumptions about deposits or left large long-term positions unhedged have faced severe losses and, in some cases, existential crisis. So to wrap up, let's recap what we've covered. IRRBB is the risk that interest rate changes damage a bank's earnings or the value of its balance sheet. It arises through gap risk, basis risk, option risk, and credit spread risk. Regulators in the UK, EU, and globally require banks to measure it under standardised scenarios, set limits, and manage it through governance frameworks like ALCO. Measurement depends heavily on behavioural modelling for deposits and prepayments. Mitigation tools include balance sheet structuring, derivatives, pricing strategies, and internal transfer pricing. Above all, IRRBB links directly into capital and liquidity management, so it has to be seen as part of the bigger balance sheet picture. Now, managing IRRBB well is about striking a balance, protecting stability in capital without overly constraining profitability. It requires technical tools, but also clear governance and sound judgment. With interest rates now volatile again, IRRBB is no longer a background risk. It's front and centre in ensuring banks remain resilient, profitable, and trusted. So here's a quick thought. If interest rates changed by 3% tomorrow, how would your bank respond? Would it be ready? Let us know in the comments below. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.